A seasoned and highly respected economist, investment strategist, and financial media entrepreneur, Raoul Pal has recently shown his disagreement with the U.S. regulatory system. He is the publisher of the Global Macro Investor, a macroeconomic and investment strategy research service, and the CEO and co-founder of Real Vision, a financial media company that provides in-depth analysis of the global economy, finance, and markets. In a recent tweet 2 days ago, Raoul Pal shared his view regarding the U.S. crypto regulatory system. Very interesting to see the SEC's attack vectors moving to U.S.-regulated stablecoins. Meanwhile, the UK, Singapore, India, China, the EU, and others keep moving forwards. From what I hear from policymakers is that the U.S. is not engaging with the other CBs and governments. He also responded affirmatively to a comment by one of his followers, Raoul Pal, who is an author and speaker focused on the future of work and cities. He's the author of Rethinking Real Estate, an award-winning book that predicted the current reshuffle of offices, homes, and cities. Proleg commented that this is the mother of all innovators' dilemma, and Pal affirmatively responded indeed to the comment. The move by the SEC vectors to U.S.-regulated stablecoins doesn't come totally as a surprise, as billionaire investor Mark Cuban already predicted in a tweet 2 years ago. Stablecoins are cryptocurrencies that are meant to be pegged to a reserve asset, such as gold or the U.S. dollar, to keep their value stable. Cuban noted that his thoughts are subject to change as he learns more. And it seems cryptocurrency payments used in ransomware attacks might be the first to be targeted by U.S. lawmakers, but stablecoins have indeed caught the eye of U.S. lawmakers as a potential threat to financial stability, with many at the center of controversy. For example, critics have questioned whether the so-called stablecoin Tether has enough dollar reserves to back its currency, since the Tether is supposed to be pegged to the dollar. But it remains the largest stablecoin by market value. Gary Gensler, chairman of the Securities and Exchange Commission, also noted stablecoins as an area of interest in his plan to create a set of rules for the crypto industry. Others, including Federal Reserve Chairman Jerome Powell, have consistently warned of stablecoins too, deeming them risky and susceptible to fraud, just like other cryptocurrencies. The Shark Tank investor and Dallas Mavericks owner also said that regulation in the space wouldn't necessarily be a bad thing and shared other opinions on the matter, which were met with disagreement from the crypto community on Twitter. Regulation won't hurt innovation, nor slow anything down, he tweeted. But any discussion of crypto regulation has to start with the facts that there are already laws against fraud and that crypto is not monolithic, Cuban said. There are many layers to crypto. Just recently, the United States Securities and Exchange Commission and its chair, Gary Gensler, were the targets of many lawmakers and witnesses at a hearing exploring the crash of the crypto market. In a February 14 hearing at the Senate Banking Committee titled Crypto Crash, Why Financial System Safeguards Are Needed for Digital Assets, Ranking Member Tim Scott said Gensler should appear before Congress before September to address additional enforcement actions in the crypto space, calling out the SEC chair for doing rounds on the morning talk shows rather than testifying. According to the South Carolina senator, the SEC had not provided the slightest bit of guidance, potentially leading to the lack of investor protection at bankrupt firms including FTX, Terra, BlockFi, Voyager, and Celsius. To think the SEC has failed to take any meaningful preemptive action to ensure this type of catastrophic failure does not happen again, said Scott. If they have the tools they need, were they just asleep at the wheel? We'd be happy to have Chairman Gensler testify sooner, much sooner than later. Witnesses testifying at the hearing proposed different approaches for lawmakers seeking to regulate crypto. Duke Financial Economics Center Policy Director Lee Reiners suggested Congress pursue legislation to carve out cryptocurrency from the Commodity Futures Trading Commission's authority and label it as a security under the SEC's exclusive purview. Crypto Council for Innovation Chief Global Regulatory Officer and General Counsel Linda Zhang testified that the lack of a consistent federal regulatory framework on crypto contributed to a lack of investor protection and uncertainty among firms. Vanderbilt University law professor Yesha Yadav echoed some of Zhang's concerns on developing a federal framework for crypto, but also proposed a self-regulatory regime in which exchanges could oversee themselves as a complement to public regulation. Firms that failed to comply with the rules could be forced to pay financial penalties. In the United States, there is seemingly a regulatory tug-of-war between many government agencies looking to establish rules on crypto companies. Gensler has claimed most token projects qualify as securities under SEC guidelines and repeatedly called on firms to come in and talk to us. The agency has already taken enforcement actions against Kraken and Paxos this year. However, 2 days ago, Coinbase, one of the biggest cryptocurrency exchanges in the U.S., stated that the staking services offered on its platform do not constitute securities. The statements made in the wake of the $30 million settlement that Kraken, another U.S.-based crypto exchange, completed with the U.S. Securities and Exchange Commission, SEC, also criticized the institution's approach to the issue. In a blog post published on February 10, Paul Grewal, chief legal officer of the company, states how getting this point wrong in regulation may affect the whole crypto industry in the country. The article explains the stance of the company on the issue, stating, "Staking is not a security under the U.S. Securities Act, nor under the Howey test. Trying to superimpose securities law onto a process like staking doesn't help consumers at all, and instead imposes unnecessarily aggressive mandates that will prevent U.S. consumers from accessing basic crypto services." Furthermore, Grewal also criticized the way that the U.S. SEC is handling cryptocurrency regulation, explaining that regulation by enforcement is a poor substitute to actual rulemaking. The position of Coinbase seems to directly oppose the stance that the U.S. SEC has taken when it comes to centralized platforms offering cryptocurrency staking services. On February 9, the institution completed a $30 million settlement with Kraken, another cryptocurrency exchange, for the unregistered sale and offer of these services to its customers. Gary Gensler, chairman of the SEC, has hinted at more actions of this kind coming for other players in the industry, stating that these companies need to disclose the risk associated with such activities to their customers. Coinbase offers cryptocurrency staking programs for different cryptocurrencies as part of its service portfolio and collects a flat fee for operating these services. In a recent report, J.P. Morgan, one of the biggest financial institutions in the world, estimates that the arrival of the next Ether upgrade, codenamed Shanghai, will bring more investors to stake their funds in the protocol. The firm believes that this number might reach 60% of the Ether issued, a number already staked in other blockchain networks. It also predicted that new staking funds coming to Ether after the upcoming Shanghai upgrade are likely to go to decentralized platforms like Lido due to the different benefits they offer compared to centralized providers.
Today's episode is sponsored by iTrust Capital, the #1 crypto IRA platform in America. We allow you to invest in your favorite cryptocurrencies without worrying about taxes. That's right, iTrust Capital allows you to buy and sell your favorite cryptocurrencies completely tax-free. That means if you invest $10,000 into Cardano and it grows to $100,000, all of your profits are tax-free. Why is it tax-free? We took the existing retirement account industry and flipped it on its head. Instead of boring stocks and bonds, you can invest in crypto. How is it secured? Through Coinbase Custody, one of the leading cold storage providers with a $320 million insurance policy to protect against theft, hacks, and loss of funds. Roll over your existing retirement account, or even start a new one from scratch. Questions? Schedule a free call with one of our crypto retirement account specialists, and they can help you discuss your options. Start your crypto IRA today and retire early, only at iTrust Capital. Click the link in the description to open a free account now.
What do you think about the effect of regulation on stablecoins and cryptocurrencies in general? Let us know what you think in the comment section below. Also, make sure to hit the like button, subscribe, and turn on post notifications. Thanks for watching.